Have you ever considered investing in real estate? Do you want to avoid the number one mistake I see investors make when they're purchasing properties as assets and not as a place to live? Check out this next episode of Tom's Take now to get the answers to those two questions and learn 3 indicators that are going to help you turn real estate into income-producing opportunities. Welcome to Tom's Take. Thanks for tuning in. Very pertinent topic this week. I was inspired to do this episode after a conversation with a great past client where he shared with me his benchmarks that he looks for when investing in real estate, and they're many of the same ones I share. So as a preface here, I just don't help people buy and sell real estate. I also invest in it, and I see a major mistake with real estate investors in the marketplace right now. They buy their properties based on the hope that the value will appreciate. So let me say that again. They base their purchases on the hope that the value is going to appreciate, and they're not looking for the asset to actually perform. So right now you take whatever money you're going to put into real estate, you can go to the stock market and get a 4, 5, 6% return. Obviously talk to a broker, talk to a financial advisor. That is not me. But you can get those returns on your money. So why are you going to buy something just to hope that the value goes up over time rather than getting it to perform? So don't make that mistake, but rather analytically look at the piece of property you're buying and use the 3 things I have behind me here to determine if it's the right investment for you or not. So the first is ROI, or return on investment. And I'm going to walk you through how to calculate each one of these ratios here to determine what you need to be looking for. So return on investment, pretty simple. The way that gets calculated is the net profit divided by the cost of the investment. So if you're renting it out for $1,000 a month, your expenses run about $2,000 a year, your net profit's going to be $10,000 divided by the cost of the investment, so the purchase price of the property. A little different than the next number, which I find is really critical to look at, which is the cash on cash return on investment. So this is much different. That gets calculated by the cash flow before taxes divided by the cash invested in the property. So again, you're making $10,000 a year on the home and you put up $50,000 to buy the property, you divide 10 by 50. You get 20%. So that is how you calculate that, because that's the return on the money you're investing, and that's similar to how you would calculate the return you get in the stock market. When you invest $100,000 and it makes you $10,000 in income, that's a 10% return on your money. That's a cash on cash return. This is really critical to look at because you want to compare this when you're buying a piece of property to what else you could do with the money, what other opportunities are out there, whether or not it's real estate. And lastly, the capitalization rate. The capitalization rate, or the cap rate, is the net operating income divided by the value of the asset. A good benchmark there is between 4 and 10%. If you can see that sort of cap rate on a home or on a property, a multi-unit, an apartment building, a flex space, if you got retail on the bottom, apartments up top, if you're in that 4 to 10% range, that's a good benchmark. Obviously, the higher, the better. If you got questions about this stuff, contact me directly. Really what I want you to focus on here is if you're thinking about investing, look at these numbers. Don't hope the value is going to go up because they're building a Trader Joe's down the street. That's not going to be the right way to invest in real estate. Thanks for tuning in this week. I'll catch you next week on Tom's Take. Really appreciate your attention.